Hello learners, welcome to today's lesson. I am Kezia Wanjiko. We continue with VAT. Today we are going to focus on issues in VAT. In our previous lesson, we looked at computation of VAT for a firm that is selling at a price that is inclusive of VAT. And we said that when the prices are inclusive of VAT, you must know that the price that you're charging the customer constitutes two aspects. One, it constitutes the selling price of the business as determined by the business, and two, it constitutes the VAT of 16%. We said a business will be required to quote prices inclusive of VAT under two circumstances. When the business is selling, one, to unregistered persons, and two, when it is selling to the final consumer, or when the business is a retailer, like a supermarket. For today, we're going to look at issues in VAT, and our first issue is going to be refund of VAT. Refund of VAT. So the question here is, when or under what circumstances? Under what circumstances does the commissioner refund VAT? So for the commissioner to refund VAT, the taxpayer or the taxable person, the registered person, must make an application in writing, and you must prove and provide documentation as to why you should be refunded the VAT that you've already paid. Now remember that we had said earlier that a taxpayer will pay VAT because he's collecting, is appointed by KRA, by the commissioner, to collect VAT on behalf of KRA. So the taxpayer collects VAT on his sales, what we called output VAT, and then deducts from the collected VAT, he deducts the VAT that is paid over to the suppliers. So he will take output VAT, deduct input VAT. That excess is what is VAT payable. And it is payable to the commissioner simply because we say the incidence of VAT lies with the final consumer. Now, there are the circumstances under which the commissioner will refund VAT is the first one, if the taxpayer is making zero rated supplies. In our earlier lessons, we said a zero rated supply is a transaction that will attract VAT at 0%. So in such cases, it means that if we go back to our account, which you said this is output tax, this is input tax. So you will have had purchases here. You've made purchases, and let's say on your purchases you paid 100,000 as VAT. Then you had other taxable inputs, for example, rent, commercial rent, electricity, telephone, audit. You got management consultancy services, such. The total of that, let's say it was 50,000. But on your sales, you sold, all your sales were zero rated, or a very big proportion of your sales were zero rated. So you collected nothing. So when you balance this, you'll have paid 150,000. You will have collected nothing. Let's say, for example, if you're exporting, and therefore you will have a VAT refund of 150,000, because we're saying VAT is not, the incidence of VAT is not on the business. It is always on the consumer. So since this is what you've already paid, then you get it from KRA. So that is how a supplier of zero rated supplies recovers his VAT from the commissioner. The other condition is in case of bad debts, what you're going to call bad debt relief. Now, in our earlier lessons, we said that a business, for tax purposes, a debt is going to be considered as bad at the earlier of two things. So one, expiry of 3 years since the date of supply, and two, if the debtor has been declared bankrupt and you can actually show, you have proof for it from a court of law. So in such cases, you're going to recover the bad debt that you paid on behalf of your debtor. And that arises because if we flash back to the earlier lessons, we had said the tax point, or the point at which tax becomes due and payable, is the earliest of 1, the date of the invoice, 2, the date of delivery, 3, the date when you receive cash, receipt of cash, whether in full or partial payment of a transaction, and 4, in case of constructions, when you get a certificate from an architect. So let's deal with these 3, the earlier of invoice, delivery, and receipt of cash. Now, when you're selling on credit, invoice and delivery precedes the receipt of cash, because you're going to receive cash much later. So it means, according to our tax point, if, for example, in January, we are selling goods worth 1 million, and the terms are that you're going to be paid in 60 days, that is the credit period, then, holding everything constant, we shall receive this, let's assume this is beginning of Jan, and so we'll get this in March. So the payment shall be received in March. So if you are accounting for cash, this is when our bank gets debited. But according to this tax point, we are going to account for this transaction, this credit transaction, in January, because in January, delivery preceded the receipt of cash. So as a result of that, it means that every business will always fund its debtors for VAT purposes. So should that business be declared bankrupt or 3 years have expired, that means there is no hope of ever getting that money back. Then this VAT that you had paid over to the commissioner, you request the commissioner to refund you, or to allow you to deduct bad debt relief from your output VAT. Then the other one is inventory relief. Now, we said that at the time of registration, once you hit the threshold turnover of 5 million and you request for registration, and you apply for registration from the commissioner using the prescribed form, the commissioner will communicate to you after certifying that you are truly eligible for registration. He will communicate in writing, and he will have there will be a start date for levying or for charging VAT. We said once you receive that communication from the commissioner, you should immediately do a stock take. So when you're doing that stock take, you're determining your inventory at the point of registration. So we're saying all the goods that you have bought and are in stock at the time of registration, you are allowed to claim the VAT that you suffered or that you paid on such stocks before the registration. So this inventory relief refers to the goods in stock at the time of registration, and to any capital, any construction or any capital assets that you may have bought 12 months prior to registration. Why? Because if, for example, we constructed a building and we paid VAT on inputs and you're using it in the production of our output, it is still relevant to us. So we need to claim the input VAT suffered. So capital goods acquired 12 months prior to the registration is claimable under this inventory relief. Then you also get a refund from the commissioner when tax is paid or had been paid in error. For example, if there was an arithmetical mistake when you are computing the tax, or if you use the wrong rate, meaning that you overpaid the tax, then you can request. So here you talk of requesting for relief of error or mistake. Why? Because in VAT, it is the taxpayer who prepares the return, or what we call VAT account. So if you did any mistake in that preparation, then you're requesting the commissioner to allow you to correct that mistake. That is why we're talking of relief of error or mistake. The other one is when VAT has been paid in respect of goods that have been exported. So VAT paid on goods that are subsequently exported. You remember that all exports are zero rated. So it means that you need to recover that VAT. So these are the circumstances under which the commissioner is going to refund VAT that a taxpayer may have paid. The other issue that you're going to look at is remission of VAT. Issue number 2. In some cases, it's also called rebate of VAT or VAT rebate. Now, remission of VAT happens when, for whatever reason, the commissioner feels that they can waive remission, they can waive the VAT either partially or in full, or any other tax, that they can waive it and therefore reduce the amount payable by the taxpayer. So in this case of remission of VAT or rebate is the actual amount by which the commissioner has reduced the tax. So like if you're supposed to pay 100,000 and the commissioner feels, for example, that the goods with respect to which you're paying input VAT were obtained in the public interest. For example, you bought stuff that you later donated to a disaster fund in case of a disaster, or to a refugee camp in case of such donations. So for that, he's going to remit, he's going to waive that. Of course, that is done in writing. And you must have notified the commissioner before you bought the goods, so that he's aware and he's able to remit that. So we're going to read from the Act circumstances under which the commissioner remits or waives either in partial or in full the tax that is due from a taxpayer. Remission can be granted to and in respect of, we are reading from the Act, A, capital goods excluding motor vehicles of a total value of not less than 1 million shillings per investment, imported or purchased locally for new investments or for the expansion of investments. This can be connected to the fiscal policy objectives, where it was said that in fiscal policy, it is a role, one of the incentives or the roles that tax plays in the economy is ensuring that there is enough tax signals and shift signals in the economy to encourage investments, both local and foreign investments. So in order to encourage businesses to expand, the commissioner waives the VAT that is payable on the machinery and everything that they need to be able to expand. B, taxable goods for emergency relief purposes for use in specific areas and within a specified period, imported or purchased locally by the government or its approved agent, a non-governmental organization or a relief agency authorized by the minister responsible for disaster management, where the goods are for use in areas where a natural disaster or calamity has occurred in Kenya, like excessive flooding or a fire or other disasters. The goods are intended for use in officially recognized refugee camps in Kenya, like Dadaab. 3, The goods are household utensils, foodstuffs, materials for provision of shelter or equipment, and materials for health, sanitary, or education purposes. 4. In case of a natural disaster or calamity, the importation of or purchase locally is made within 6 months or such further period, not exceeding 12 months, as the Commissioner may permit in each case. Part C, when the Commissioner can waive the tax or remit it. Goods, including motor vehicles and aircraft, and taxable services imported or purchased by any company which has been granted an oil exploration or oil prospecting license in accordance with a production sharing contract with the government of Kenya and in accordance with the provisions of the Petroleum Act. So that is the likes of Ngamia 1, Ngamia 2. D. Capital equipment and machinery imported or purchased solely for use in the manufacture of goods in a licensed customs bonded factory for export only. Now, if you're manufacturing under bond, it means you've already entered into an official contract with the customs department that everything you produce shall be for export. So the date you breach that or you start selling locally, that bond is cancelled, and therefore you start paying taxes like every other taxable person. Then E, official aid funded projects. F, goods including motor vehicles imported or purchased by any company which has been granted a geothermal resource license in accordance with a production sharing contract with the government of Kenya and in accordance with the provisions of the Geothermal Resources Act. Currently, we have Kenya Power doing that. G, goods for official use by Kenya Armed Forces. Goods supplied as ship stores to the national carrier of any airline designated and under any air services agreement between the government and a foreign government. Then H, goods imported under bond for manufacture of exports, indirect exports, goods free of import duty, goods for use in official aid-funded projects, or goods for use in manufacture of goods which are in turn supplied to another manufacturer of goods under the Essential Goods Support Program. Then I, taxable goods and services supplied by a registered person for use in the construction or expansion of private universities, excluding hostels and staff housing, with the approval of the minister on the recommendation of the minister responsible for education. The minister is what we currently call the CS. Taxable goods and services supplied by a registered person to a specific project approved by the CS on the recommendation of the minister or CS responsible for housing. Then K, you're told the Commissioner may grant remission of additional tax in individual cases where he is satisfied that the remission is justified, provided that where additional tax exceeds 1.5 million, the remission shall be subject to prior approval by the minister. So in short, you're saying the minister will waive or will reduce the amount of tax payable by a taxpayer if he feels that it is in the public interest to do so. That's the key thing. So remission is done in public interest. The Commissioner, with reasons, reduces the amount of VAT payable by the taxpayer or by the registered person. The third issue that we are going to look at is withholding VAT agent.